Fibonacci's have completely transformed my trading. While most traders struggle to understand these concepts, I will teach it to you so simply that you'll be able to start applying it immediately. And even though YouTube makes this out to be an ultra complicated concept, I believe it is one of the best strategies for beginners in 2025. In this video, I'm going to be covering everything you need to know about Fibonacci's, how to draw them correctly, key levels, how to find them for entries, exits, and how to combine them with other confluences for maximum effectiveness. First of all, let's talk about what are fibs. Fibonacci analysis uses the work of 12th century Italian mathematician Leonardo da Pisa, also called Fibonacci. And yes, you might say, Antonio, you're biased because you're also Italian. Well, this wasn't my uncle or anything, but it's very effective in your trading. It uses a logical sequence of numbers to anticipate stock trends and price action. Why did it actually work? Well, think about it. Fib retracements make people think it is a good time to buy the dip on a certain stock, while fib extensions make them think it might be a good time to take profit or short sell as price has moved in an extended direction. Human emotions work in cycles. This is why price actions and Fibonacci's can give us an insight on where the human emotions might take price and might give us an edge over other traders. How do I like to use them? Well, I use them for pretty much everything. Looking to buy the dip for a continuation plays, looking for a potential reverse area. I look for them as a profit target, as a stop loss, and other confluences along the rest of my trading plan. It is a key way for me to trade, and I use this every single day in every single trade that I take. Let's get to the chase. What are the Fibonacci settings that I use? Well, here it is. You can copy it exactly and add it to your trading view. The key ones are going to be the 0.66 and the 0.618. That is the golden pocket, the one that I'm most famous for creating, and a lot of people are picking up now on socials like TikTok and Twitter. If you want, I have a full video on this one specific that you can watch later. The other ones I use is the 0.5, the halfway retracement, and the two extensions is the 1.272 and the 1.3414, and the opposite will be the negative versions, which is negative 0.3414 and negative 0.272. Add them to your trading view right now so you don't forget and come right back to this video. Let me show you how I use the golden pocket in today's trade that I took live with my team. As you can see, we have a key low, which was the pre-market low at 7.55, this candle. Tapped that candle, and then I fibbed the top of another important candle, which was at 10 a.m. Right after the news, we had a red folder news. So this is my Fibonacci pull. Why? The key low, which is pre-market, to a news high. This gives me an obvious direction of where the market wants to go. Now we see right here, we have the 0.618 and the 0.66, my golden pocket zone. We see the price perfectly bounces on it. And as we get confirmation of that bounce, we found a continuation play with a stop loss below it to look for a target all the way back up to the previous day price, which was roughly 20,170. We were able to catch this high risk reward trade thanks to using the golden pocket. But now that gets me to the next step. How should you be drawing your golden pockets or your Fibonacci's in general? One of the biggest common mistakes that I see people do whenever they're trying to draw golden pockets or any type of Fibonacci's, they don't understand the highs and the lows to use. They'll just find any low and any high and they draw and they're like, well, this did not work. The truth is that you need to look for high probability and importance of key highs and key lows. This should be any news low to news high. This should be pre-market highs, low, Asia session, London sessions, New York sessions, high and lows. FOMC. All of these important key swing highs and lows are going to be more powerful when you're using your Fibonacci's. Also, another one can be just a very, very obvious key swing, whether it's a high or it's a low. We also understand that time frames have importance in the fibs. We can use them on all time frames. We can use from the 1 minute all the way up to the monthly time frame. Let me show you a quick example of what is a proper pull versus an improper pull in today's trading session. Number one is you are looking not for, a lot of people are like the latest low. They're like latest low to latest high right here. Although this did work, this should not be a proper pull because you're trying to look for an important key high or low. So for me, the pull would have been this bottom right here, which was the pre-market bottom. And you can see I'm also using the wick. I'm not ignoring the wick. If price has hit a certain dollar amount, I want that to be part of it. I'm not using candlesticks. I'm not using just the body. I'm using the whole wick. So I'm marking out where's my pre-market low or pre-market high. As you can see here, this will be my low. And I will mark it as pre-market low. And I can do this before the market even opens up. Then I can mark out any key swing high or low. As you can see, this one you could have marked out. But in this case, we start building a bullish trend, and a Fibonacci retracement, you have to keep in mind, it's going to be retracing the trend. So if you're in a bullish trend, look for bullish pulls along that trend. So then I'm looking at the markets and looking, hey, we have a 10 a.m. red folder news. So I'm going to be wanting to wait for that to play out before pulling my fib. So I pull it from the pre-market low to the news high, which was at this 10 a.m. candle news high. Can mark that as well. News high. And marking it will help you slowly make it second nature on when and how to draw them. Now, before price even happened, we can go to our replay mode and we could cut it to here. Rather than, hey, I want to chase this trade, I'm just gonna long here because price looks bullish. I know that I'm going to be looking for a long position between the 0.5 all the way to 0.6. So if there is any longs, it should be here. If there was a fair value gap above it, it will line up with the 0.5. That can be a potential entry, but since there is not, my only potential entry should be this golden pocket. Now, as price approaches it, you see we get the bounce, but I'm not just blindly entering. As you can see here, big candle to manipulate, get people scared, and then big rebound. When price sits here on the 5 minute, I'm jumping to the 1 minute, and I'm asking myself, where is my first entry? In this case, we had a bearish fair value gap right here. They got disrespected. This tells me, hey, we just bounced off the bullish golden pocket in a bullish trend, marking out key swing high to key swing low. Let me enter this trade. Now that I have confirmation with an inversion fair value gap and I get my stop loss under that candle, mark out the news high that was also kind of relative equal high, and boom, hey, my full take profit. Remember, to draw this properly, use it within an uptrend or a downtrend. Understand what retracement means, which means you want to retrace, and to retrace, you need to be in some form of trend. It should not be used during random chop. The golden pocket needs to be used for when to dip buy and when to have a continuation. Without a trend, you cannot use this tool. Use key points to mark your lows and highs, just like I show you, and use the wicks, not just the body. If prices reach the level, it should always be used. How do we make the golden pocket more effective? The best way to use your golden pocket tool is to combine it with a larger time frame market structure that follows the golden pocket trend, such as bearish fair value gap, bullish fair value gap, to add an extra confluence. Waiting after you have a sweep of liquidity can also make this tool much more powerful. It's great to pinpoint exact entries with very low risk. Let's go over another example here so we can really remember this concept. I'm looking for the latest high. As you can see, the latest high was the green wick candle. Then we took out the previous low. That is a key confluence that we can use with a larger time frame for value gap, as this is the 1 hour time frame, and we take the lowest point of the pre-market area to then give us the golden pocket at 5561. So we have the golden pocket, it lines up with the key previous day low and also a high time frame bearish for value gap. These three confluences together gives us a great trade to take to the short side. Now let's talk about how do we use the 0.5 retracement. The 0.5 is a key Fibonacci to use when we're looking at halfway point of ranges. A general rule that we can use is that above a 0.5 range, you're buying an expensive asset, while below it, you're buying it at a discounted price. This means it has more likely to reverse at that point if you're looking at dip buy. Also, really like to use it during news candles. A lot of times we have an 8:30 news such as CPI. Price will retrace to the halfway point of it to then continue to overall trend. While if we flash it, more than likely we will see lower on the trend. In more aggressive trends, can also be used a golden pocket like entry and use your golden pocket as a stop loss. How to use it properly? Use the 0.5 when you have a very aggressive move towards one direction. A strong trend, it is why it is very powerful when you combine it with news. Here we had a big news candle we fibbed out the news and you saw the 0.5 at 5660. That was the exact bottom of the retracement to then push higher. This can also be very powerful to use when we combine it with fair value gap. Use this rule of thumb of a fair value gap may work better. The ones below it tend to have a better entry price. So if a fair value gap is above the 0.5, it is less likelihood to work than a fair value gap that is below it. That is, of course, if we're in a bullish trend. Let's take a look at how we can use the 0.5 in combination with the fair value gap. Nowadays, this becomes a lot easier because if you take your rectangle tool and you go to your settings tab, you can automatically go to style and add a middle line. This means it will show you the 0.5 of the rectangle. So when we draw our fair value gap, we can draw it, for example, in this hourly fair value gap here. And we can see the 0.5 is going to be the key point to potentially look to take a trade off of. So every fair value gap that I'm personally trading, I'm looking to see if the 0.5 is going to give the rejection. I'm not looking if it just taps into it. I'm not looking if it's getting fooled. I'm usually looking if the 0.5 is getting tapped. Then, for example, in this trade, I can look at a long position, take it here, bring this up all the way to the bottom of the fair value gap and use that as my stop loss, and then look at a potential positive risk reward for a trade. This gave about 100 point reaction here, little 2.69 R. You can see the trade is actually still ongoing and it could go much higher. But for this example, this is where we are. There's a trade that we took yesterday actually on Asia session. We could call this long here around 9 p.m. and we call some of this move back to the upside. The 0.5 is the one I tend to use the least because it's only mostly if I'm using fair value gaps or if I'm using it during news events. Next up, let's talk about the TR pocket. This is the trend reversal pocket. It's something that almost no one uses, something that I invented myself. The TR pocket gives us potential reversal point after a consolidation period of a trend. It can be used the same pull as a golden pocket to aim a target, or can be used within a chop zone to where to expect an AMD of it to line up before a reversal. That's the two key ways I'm using the trend reversal. If I'm looking at choppy area, I'm not going to be using the golden pocket. I can use the TR pocket in combination with accumulation, manipulation, distribution setups to see where price more than likely it is to manipulate, then reverse and continue the opposite direction. While if I use the golden pocket entry, I can use my TR pocket as a target for the golden pocket long or short. As you can see from this example right here, we had a period of pre-market accumulation and we fibbed it out, and it shows the TR pocket give us the high at 561 to 5564. Let's look at a good example on how we were able to use the TR pocket in a choppiness when also combining with RMD. We can see we had a small period of chop right here, and if we fibbed it out, we got a manipulation down to 5600, then quickly V-shaped recovery above it, held the golden pocket over that range and pushed the opposite direction. This is also giving us confirmation when we're looking for an inversion fair value gap or a fair value gap entry that the TR pocket was bottom to confirm the potential reversal. Of course, these confluences can be used in all time frames. So if we take a look at this 1 hour period of chop right here, which we could just simply draw a box around right here, you can see we can draw our Fibonacci TR pocket, and as you can see, the top becomes the one side and the bottom becomes the opposite side. It would be great points to look for potential reversals. But to show you that this is not just a random cherry-picked point, we can draw another consolidation zone. If you can see here with the smaller consolidation zone from the bottom of this green candle to the top of this red candle, as you can see price pushed up, hit the TR pocket to the upside, then we reversed and then back up, and then you see, rest is history. So when you're looking for this TR pocket, the main key thing to understand is identifying a chop zone. And how do you identify a chop zone? Simply when you're like, what the hell, where is price going? Whether it's on the 5 minute, on the 1 hour, on the 4 hours, you just have to look where has price not giving you a clear direction, and how can you draw your TR pocket to then help you execute on where price should go, to then catch the reversal to the opposite side. TR pocket is also a great tool to use for take profits target. Since it is an extension tool, it should tell you where price is extending to potentially take profits. The tier pocket is also a great tool to use when price is inversed. So if we look at this obvious range, as you guys can see, a price went essentially sideways for this period of time after a strong move to the upside and another strong move. It's followed by another strong move with news. We can see when price is broken above the tier pocket, it is used as a level of support. Here and again, here. You can use this tier pocket for another confluences to potentially follow the trend when it is broken. You can almost see this as an inversion for value gap, but for the tier pocket. Now let's look at this other example and how we could find the exact entry after a tier pocket. So we fib out a level of consolidation, as you can see here. We hit the bottom tier pocket at this 21,151 level after we took out a key low. And our entry would have been after the bullish candle inverses the bearish candle with a target of at least a positive risk to reward, but more than likely the opposite side of the tier pocket and higher. This gives us minimal risk. This gives us a confirmation entry by looking for the inversion fair value gap. This gives us the liquidity sweep that we like to look for even added confirmation, and also confirms a trend reversal. Now, what are some mistakes to avoid when we're drawing out fibs? Do not be an idiot and draw your fibs upside down. Guys, I say this all the time, right? People will just draw their fibs and not understand. Guys, it's basic math. If you draw an extended move to the upside, where should 0.618 retracement be? Above or below the 0.5? Of course, it should be below it, right? Because the 0.5 is a lesser retracement than 0.618. So if you draw it upside down, the opposite way, where should your fib be? The fib should be above the 0.5. Please don't forget this. Do not draw your fibs upside down and then come back to me and be like, Antonio, it's not working. I cannot help you with that. Do not solely rely on any fibs. You might have not drawn them right to make sure you're lining them up for other confluences and using them for confirmation. Guys, no single tool should be used alone. There's no holy grail that just this one indicator tells you to buy or sell. You need to actually understand when it's working, why it's working. You need to make sure you're using a key times, key swing highs, swing lows, and then apply it into your trading. And that's when it becomes very powerful with other confluences as well. Understanding takes some time to learn how to actually draw them right. You might have to watch this video 2 or 3 times and it's totally fine. Understand which highs and lows need to be drawn for an easy way to mark your up pre-market ranges, previous day range, draw those out, and that's a good way to start. Draw your red folder, highs and lows for as well added key points. Add anytime price has swept liquidity that can also be used as confluence high or low, as well as key times such as 9:30 a.m. New York Open. If you found this video helpful and want to accelerate your trading, I want you to think about my mentorship. Rather than me telling you how amazing it is, I'm just gonna flash some of the wins we've had lately so you can see the type of results the students are getting. Even if you consider yourself a good trader, I'm telling you this is the best path you can take to take the next step and become a great trader. Stop settling yourself as an amateur. Click the link down below in the description and find out more about my mentorship. Thanks for watching, and I'll see you in the next video.